Section 1. The bank's role, a financial balancing act. Banks are businesses. They take our deposits and use that money to make loans. Think of it like a giant pool of money. We put money in and the bank lends it out to others. The interest they earn on loans is how they make a profit. It's a cycle of borrowing and lending, carefully balanced to keep the financial system running. This system relies on trust. We trust banks to keep our money safe and accessible. Banks trust borrowers to repay their loans with interest. This delicate balance is at the heart of modern banking. The interest rates banks charge on loans are typically higher than the rates they pay on deposits. This difference, known as the interest rate spread, is a key source of profit for banks. It allows them to cover their operating costs, pay their employees, and generate returns for their investors. Section 2. Interest rates. The engine of your savings. Interest rates are the engine that drives your savings growth. They represent the cost of borrowing money or the return on lending it. When you deposit money in a savings account, you're essentially lending it to the bank. In return, the bank pays you interest. Several factors influence interest rates. The central bank's monetary policy plays a significant role. Economic conditions, such as inflation and growth, also have an impact. Supply and demand for credit also play a part in determining rates. Understanding these factors can help you make informed financial decisions. The interest you earn on your savings is calculated as a percentage of your balance. Higher interest rates translate to more money earned over time. For example, a $10,000 deposit at a 2% annual interest rate will earn you $200 in interest after 1 year. The same deposit at a 4% rate would earn you $400. Section 3. Maximize your returns. Finding the best rates. Not all banks offer the same interest rates. Shopping around and comparing rates from different institutions is crucial for maximizing your earnings. Online banks often offer more competitive rates compared to traditional brick-and-mortar banks. Credit unions are another excellent option to consider. These member-owned institutions typically offer better rates and lower fees compared to traditional banks. Don't be afraid to negotiate with your current bank for a better rate. Loyalty can sometimes pay off, especially if you have multiple accounts with them. Pay close attention to the terms and conditions associated with different savings accounts. Some accounts may have minimum balance requirements or monthly fees that can eat into your earnings. Read the fine print carefully before making a decision. Section 4. Beyond the basics, high-yield savings and money market accounts. For those seeking higher returns, high-yield savings accounts and money market accounts are worth exploring. These accounts typically offer more competitive interest rates than traditional savings accounts. They come with certain restrictions, such as limited withdrawals or higher minimum balance requirements. High-yield savings accounts offer the flexibility of easy access to your funds while still earning a competitive interest rate. Money market accounts often come with check-writing privileges and debit cards, making them a good option for managing short-term savings. It's essential to compare the features and requirements of these accounts to find the best fit for your needs. Before opening any new account, carefully review the terms and conditions, including fees, minimum balance requirements, and withdrawal limits. Make sure you understand the potential risks and rewards associated with each account type. Section 5. Time is money, the power of compounding. Compounding is a powerful force that can significantly accelerate your savings growth over time. It's the concept of earning interest on both your principal and any accumulated interest. The longer your money stays invested, the more it compounds, creating a snowball effect. For example, if you invest $1,000 at a 5% annual interest rate compounded annually, you'll earn $50 in interest the first year. In the second year, you'll earn interest on both your initial $1,000 and the $50 in interest you earned the previous year. This means you'll earn $52.50 in interest in the second year. Over time, the power of compounding can lead to significant wealth accumulation. The earlier you start saving and investing, the more time your money has to compound. Even small, consistent contributions can grow into a substantial sum over the long term. Section 6. Diversify and conquer. Spreading your savings strategically. Don't put all your eggs in one basket. Diversifying your savings across different accounts and institutions can help mitigate risk and potentially boost your returns. Consider spreading your savings among high-yield savings accounts, money market accounts, and certificates of deposit or CDs. CDs offer fixed interest rates for a set period, providing predictable returns. However, they lock your money in for the duration of the term, so you won't have access to those funds until the CD matures. By diversifying, you can take advantage of different interest rate environments and account features. Regularly review your savings strategy and make adjustments as needed. Life changes, financial goals evolve, and interest rates fluctuate. Staying informed and adaptable will help you make the most of your savings. Section 7. The risk-reward tightrope: balancing returns with security. Higher interest rates often come with higher risks. Before chasing the highest possible returns, it's crucial to assess your risk tolerance and ensure your savings are adequately protected. Federal Deposit Insurance Corporation, or FDIC, Insurance and National Credit Union Administration, or NCUA, insurance provide a safety net for your deposits up to certain limits. FDIC insurance covers deposits in banks, while NCUA insurance covers deposits in credit unions. These insurance programs protect your savings in the unlikely event of a bank failure. Before opening an account, verify that the institution is FDIC or NCUA insured. Remember, preserving your principal is paramount. While maximizing returns is important, it should never come at the expense of losing your hard-earned savings. Always prioritize the safety and security of your funds. Section 8. Consistent savings: the key to long-term financial growth. The most effective way to maximize your interest income is through consistent savings habits. Set realistic savings goals and automate your contributions. Treat your savings like any other essential expense and make them a non-negotiable part of your budget. Start small if you have to, but make saving a regular habit. Even small amounts, consistently saved over time, can add up significantly thanks to the power of compounding. As your income grows, increase your savings rate proportionally. Remember, building wealth is a marathon, not a sprint. By developing disciplined saving habits, you'll be well on your way to achieving your financial goals and securing your financial future. Stay the course, remain patient, and let the power of compounding work its magic.